Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer. Thank you so much for giving us a few minutes of your time. This week I have Grant Sullivan, Senior Advisor out of the Indianapolis office, former superstar athlete out of Westfield, Shamrock himself, Grant Sullivan.
Thank you so much. I appreciate that. And I'm so sorry, folks, for all of you that are anticipating Andrew this week. He is taking a much needed vacation, as you all can possibly imagine. Managing portfolios for so many of our amazing families like yourselves can be a taxing job. And so we like to get him out at him every once in a while. And so this week is that once in a while, and he'll be back joining you guys next week. And so it's so good to be here. I don't know about superstar or super athlete, Adam. I was kind of more the middle of the rung. I know you probably carried that title back in the day more so than I did. And so definitely looking forward to having a great market carver with you guys. And so kind of looking at what some of the topics that Adam and I are going to dive through this morning for this week's edition, definitely want to talk about the Fed, what they're saying, and they're speaking loudly, how second home demand drops and why it's important for you and our outlook, and then kind of what's coming with international valuations and why we're keeping a close eye on that as a team. More importantly, why Adam and Andrew are so focused on that topic. So Adam, tee up, my friend. So what's going on with the Fed? What are they saying, and why is it so loud?
Yeah, I think for context here, and just in general speaking, the Fed's got an array of tools in the toolbox, and one of the biggest one is to just simply use their words. They actually very intentionally use their speech and their opportunities to speak to the public to actually try and accomplish some of their goals, to prepare the markets for what is coming. And that's been a big piece of what's happened over the past week or two. They have used some public speeches to clarify their intentions. One of the biggest is on how they're going to manage their investment portfolio. We found out from the last meeting that they would be letting us know between now and then what their intentions were with the several $trillion they have accumulated. And up until last week, we didn't quite exactly know what they would do beyond just letting those bonds mature. But we found out last week they might actually be willing to outright sell. While that may not sound like a big deal, it is a significant change in policy and has been just one hit after the other to the bond market. So when you've got one of the biggest buyers of bonds out there, the Federal Reserve, turning into sellers, interest rates have kind of freaked out and skyrocketed. So that's just one more piece towards that. So we'll find out here in the coming weeks. That's just a Fed speech, we'll say, but they will formally meet here in a few weeks where they'll actually commence that activity. But bar none, that is one of the most significant pieces this year, is a continued sell-off in interest rates, which is becoming one history-making level after the other. Moving along now to second home demand. And what we see here is, speaking of those interest rates shooting up, one of the biggest questions is, at what point in time does that impact home demand? When do we have some sort of a hit into that sector? And we've got a piece here breaking it down between primary homes and second homes. So primary homes by far are the more important thing to the economy, right? A much larger portion own a single home, obviously, than second home. So we've not seen a major hit yet on primary homes from that backup in mortgage rates, but we have seen some sort of slowdown in second homes, which is a significant drop. Now, this data has a little bit of a lag, and we've seen mortgage rates do nothing but surge. So naturally, and as logic would dictate, the more we go up in interest rates, the harder it's going to be for those home builders, especially those on the lower end, to be able to step into the home they were planning on just a few short months ago. So Grant, I'll just ask you if, as you meet with individuals out there, is there's any anecdotal evidence, any changes you see in plans from home building?
No, absolutely. It's as you put it, primary homes are the primary marker we're paying attention to, Adam, for especially the families that we serve. And so that's becoming harder and harder to acquire homes for some of the families that we serve. And when we take a look at second homes, we're actually talking, some of our families are downsizing, right? So they're getting into smaller homes. And so hopefully this data here can be a positive impact on families who are looking to get into their more or less your life after work home. And again, unfortunately, it's a really hard time to buy a property. Interest rates are going up, but there's still a lot of families looking for their primary home. So there's a lot of information in this data, but that's what we're seeing on the planning side.
Oh yeah, the need for housing is significant. Generally speaking, we've got 5 to 7 million, just a ballpark shortage of houses in the United States. It's just simply from a number of years of household formation relative to how many we've built, and that's one of the major reasons why we've seen home prices continue to escalate. I mean, inflation has been one piece of it, but part of it's just been such a strong demand relative to supply, and it's inevitable that those two will come into greater context. So longer term, there's going to be the need for that housing, but interest rates going up 1.5% or 2% real quickly is a big change short run. And you can look at home builders down 25, 30, 35% year to date as evidence of what's happening there. So potentially a sector we'll have our eye on that'll have a future, but for now, they're certainly working against the wind. Lastly, here, we're just going to take a look at valuations and where we ended up with the quarter. And this is a busy chart here. Just to simplify it, we'll focus on the right panel, which shows you the US, Japan, Europe, emerging markets, China, and the range of what their price to earnings ratio. So this is what we call valuation. How much are investors willing to pay relative to earnings? And the gray bar represents the range from top to bottom over the past 25 years. And then the blue dot represents where price to earnings ratios are now. So if you start with the US, the left side of that right panel, you will see there that we have actually come down with the stock market that has begun to at least pull back. The valuation levels have come into something closer to normal, but are still well above their averages. This is, by the way, just in no way, shape, or form indicates what the market's going to do over the next, say, 12 to 24 months. But over the long run, valuations tend to find their norm. So here in the United States, we're still a little bit above. But one of the things, and this is the positive thing around the world, there are places that have opened up to be opportunistic, especially in Europe, which has gotten hit here with the Russian attack on Ukraine, and certainly the proximity to that has pushed downward their prices more than a lot of places around the globe. So one thing that we could see is that we have seen international price to earnings ratios still well below their norms. That's not the case for your broader emerging markets, but in the case of Japan and Europe and even China, if they were to return to their 25-year average, that would actually be a tailwind and be a positive for their return. So in a quarter or two here where seems like we've shared a lot of bad news, one thing that we have to keep in mind is that we've got a world in which we can invest, and a lot of pockets are appearing to get more attractive as we go through time here. So that'll just about wrap it. Grant, do you have any parting words for us? Anything you'd like to add?
Absolutely. And that final slide, going back to the evaluations, for some of the families that we serve, Adam, we get questions like, hey, when is it going to be time to engage across seas or across the pond an opportunity, or why are we doing some of that today? Some families believe that we just holistically stay domestic. But just to Adam's point, folks, just remember, you've got to go seek and find opportunity where it's available. And because of some of the unforeseen geopolitical environments that we find ourselves in, some of that opportunity is starting to rise. And so don't be surprised when you see Adam and Andrew and the allocation team going after baskets of opportunity in those exchange traded funds across the pond to seek some of that opportunity that is kind of rising to the top. And so, folks, for those of you that we serve, it is an honor. Thank you for your time as always. If you're watching this and you're looking for a team that's has the potential to come take a look at your situation, evaluate it as if they're in your position, and take care of your money as if it is their own, that is who we are. We manage and mitigate financial risk as much as possible. And so give us a call, 800-928-4001. Brittany will be on the other line to set you up with a next steps meeting. And if you're looking for more content that's produced by either Adam and Andrew and our fine allocation team to Elements in Focus to our Consider This program, we're on most podcasting and services near you, YouTube, as well as the radio stations below. Thank you again for your time. We appreciate being with us. We'll see you again soon.